Hi, welcome to T-Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts. Today we're going to be talking about a very important subject regarding stock market volatility. We're currently filming this. It's the 4th of March, and the market is going through some ups and downs, mainly due to there's a lot of tariff talk out there. And I thought that would be a really good time to view some history on what normal market volatility looks like. We can look back to previous years to see, how does markets go up and down throughout the year and sometimes finish even at higher than where they started.
And the whole point of this video is not to scare people, but just to remind them that what we experience even as of today with volatility, it's pretty normal.
Yeah.
It's been normal for decades and doesn't necessarily mean that the year will end up however the market's doing right now.
Well, I think it's a good point, to keep in mind that things get sensationalized all the time, especially in today's, 24-hour news cycle, and things always seem like this has never happened before. And so we wanted to take you through a little bit of history to see how these things shape out. All right, so we have a really neat chart from JP Morgan. They put this out quarterly. This is the most recent quarter. This goes all the way through the end of 2024. And what you're looking at is S&P 500 intra-year declines versus calendar year returns. Now, I know there's a lot going on this chart, but this goes back to 1980 over here on the left-hand side. And the gray bar is what the S&P 500, what the annual return was for that year. And the red dot is what the intra-year decline was. And I really like to show this, especially when we get times of volatility like we're in right now, because you can look back through 45 years of history and see every single year we have some type of intra-year decline. I think that's a really important part because it's not always just this lower left, upper right chart of nice and smooth, sailing in the stock market. We've become accustomed to some of the ups and downs, but when we're in the midst of volatility or even a correction in the market, and again, a correction in the market, that can be a 10% drawdown. It's important to kind of take a step back. Remember, most of us have been through these times before, and we can kind of see what is normal, and that's like at least a good place to start. And so what we're looking at here, over the last 45 years, roughly 75% of the time, the stock market has positive annual returns. You can see, there's like some years down here where the gray bar, has some negative years. But on average, 75% of the time, we have markets, trending up. I think what's really interesting is every single year we have some type of drawdown. We can look back through some recent times. So 2024 was not a really volatile year. The S&P ended up 23%. The biggest drawdown that we had was down 8%. And that was due to the Japanese central bank raising interest rates. I think we've talked about this a couple times, but the Japanese central bank raising interest rates made the S&P 500 have a decline, and it really didn't last all that long.
No, it was a flash decline.
Yeah. The year prior to that, up 24%. The market was down, had an intra-year decline of 10%. That's 2023. And I think that was due to, just worry, was the Fed going to, keep rates too high for too long? And it was a lot to do about the Fed. This one right here was 2022, where we had a bear market. The market was down 25%. It ended up down 19% on the year. And that was due to the Fed actually aggressively raising rates due to the inflation that we saw. We can kind of go back to times like COVID. This bar right here, this is 2020. We had a 34% decline in 2020 in the S&P 500, yet at the end of the year, it ended up 16%. That's one of the more unusual numbers. We can go back, way back. This big drawdown right here, this was 2008. The market ended up down 38%. We had a 49% drawdown that year. That was, obviously that's a big one. It's the biggest decline on this chart. Another interesting one to look at, and I just noticed this one, Jay and I were talking about it. This is 1987, the flash crash where the market crashed. Was it on a Monday, right?
Yep.
Black Monday, I think they call it, something like that. The market was down 34% that year, or the intra-year low, 34%. It ended up the year up 2%. While that's not a big, return year, it still was a positive year. The people who panicked and sold down 34% were really probably kicking themselves towards the end of the year. Mm-hmm. But if you were to average out all these red dots, the average intra-year decline, it says it right here, is 14.1%. So if you kind of think about that, each year, on average, we have a 14% pullback. Now, obviously, some years are more than others. That's just an average, but that's a good kind of starting point to say, hey, every year we have these pullbacks, and it will always be the market will find a reason to pull back. And it's not always, it's almost never the same reason. It's always something new that the market worries about. This year, it's more, at least currently in 2025, the market's a little, concerned about tariffs. How long do they last? What is the impact? And those are all valid concerns, but that doesn't mean that the whole year is shot and it's all downhill from here. I think if we kind of look at history, there's still a good probability that we end the year on a higher note. We don't want to get caught up in today's, panic along with, the rest of everybody on the news and kind of get ourselves all turned around.
I mean, even look at 2020 when COVID happened. That is a once in 100-year type situation.
Yeah.
And everyone was freaking out, which rightfully so. The whole world just came to a standstill. Businesses closed, people weren't working, and that was a very scary drop. I think that was over the course of a couple months. And so if you had sold off then, well, you had missed out on that, what was it, about 16% return with the S&P if you had just decided to ride the roller coaster and just bear with that bad time.
Mm-hmm. And something to think about, it's in the fine print here, it's way down at the bottom, but even with all these, ups and downs, the intra-year decline of an average of 14.1%, the annual return of the S&P is 10.6%. Now, that's a very healthy return. I know you ride some of those ups and downs, but just kind of think about that for a second. Annualized 10.6%, that's above inflation. Those types of returns help you meet your long-term goals. That is what long-term investing is about, is getting those, riding some of those ups and downs and getting those longer-term returns that are going to get you to what your goals are, down the road. Don't get so caught up in today's news that it totally can derail you, because it happens, the emotional side of things is the most powerful feeling, and it can really just take you off track and mess things up for you down the road.
And then just one more final point on this. So obviously, if you were invested in, let's just say, an ETF that's mirroring the S&P 500, you're going to experience these drops and ups.
Yeah.
Okay. Now, if you have your funds, retirement accounts, what say you, in more of a diversified portfolio where it's not all mirroring just the S&P per se, but just spread across over all the very different sectors, well, that could help you at least mitigate some of those downturns that we have, or even some of the down years that one could have. Going back to the COVID 2020, market was down, or the S&P was down 34%. I want to say the average diversified portfolio was down about 19, 20%. So
Yeah.
I mean, that shielded you about 15, 14% of what the actual intra-year drawdown was.
No, that's a good point, because some people are all stock and they want to realize the highest annual return, and with that, with the ups and the downs, you get a good annualized return, but you are on that roller coaster and you're hitting the peaks and the valleys all the time. And some people can handle that and some people can't, and it's okay if you don't want as much up and down. It's a better emotional outcome if you kind of de-risk the portfolio a little bit. Maybe you have some diversified assets in the account, and that can mean a lot of things to different people, so we won't go too much into that. But you don't have to have everything in the S&P 500 or everything in cryptocurrency or everything in the latest technology stock. Sometimes you want to have just good, boring, dividend-paying stocks in your portfolio that help you ride out some of the crazy times. Diversification really shows its benefit, when we have volatility come into the market. But it also means that you're not always going to own the most latest and greatest sexy stock that everybody's writing articles and talking about, and that's okay too. Maybe having a little bit of each can help kind of tamper some of those emotions. But this is a really good chart just to take a step back when we have volatile times, look at what we've experienced, at least in the past. You can really get a lot of good information and at least know, hey, we've been here before and we'll be here again at some point in the future. Maybe right now we're in the midst of, the market pulling back a little bit. That doesn't mean that the whole year is shot. It just means that we're going to be on a little bit of a ride for a couple months, and that's not uncommon.
No. Well, we hope you enjoyed this video. If you do, please like and subscribe and share it, and we'll see you at the next one.